gold, it goes up in price, not only because they're taking it back, but because to the extent that you're a Western country and you need to keep that financial leverage, you have to start finding more gold. You have to replace it, right? So the price of gold is being bought by three entities right now, three macro entities. One is the BRIC'S. They're buying, they're repatriating their gold, and they're buying more because of this MBridge platform. MBridge means monetary bridge, right? It's a monetary bridge off the dollar. The second entity that's buying it are the Western entities that like, oh, we've lost 50% of our gold to do business with. We need to find other sources of it. So now they're paying higher prices for it. They're raising the floor on the price. And the third entity is an extension of the second entity, and that would be bullion banks that are short too many futures against physical metal. So the price of gold is going up because they found a reason to use it. And
all right, so let's discuss the BRICS and de-dollarization. What is your analysis of the BRICS de-dollarization, which is currently happening on the margins, and their use of gold to settle their trade imbalances? And how will this all impact the price and availability of gold as this de-dollarization picks up steam?
Right. Okay. This is something, this is a topic that's been near and dear to my heart since 2021, 2022, when outside of maybe one or two other people, this is like a self-plug here, I identified M-Trade. I'm sorry, M-Bridge. I keep calling it M-Trade. The M-Bridge is the platform. But anyway, to answer your question specifically, the BRICS seek to divest themselves of, this is ongoing, this is happening right now, right? The BRICS seek to divest themselves of the risks associated with holding dollars. Now, the main way that they hold dollars is in U.S. treasuries. They hold the treasuries because they get an interest rate on them, and they convert those treasuries into dollars when they need to buy something. In this case, we'll say oil, right? Because of the Ukraine war, catalyst, the Ukraine war and the U.S. reaction to that, to sanction Russia and confiscate wealth, dollar-denominated wealth, has made the BRICS even more urgent in getting out of this dollar counterparty risk, is what it is, right? So they don't need another currency, right? I'm going to make clear, they don't need another currency. They all have their currencies, and they can create a currency. But what they need is to find a suitable replacement for treasuries to store economic wealth not being used. Oh, we just raised $1 billion in taxes. I'm some, BRICS country. What are we going to put it in? Well, we're not going to put it in oil. I mean, we could, but, we don't really have any place to store it. We're not going to put it in, soybeans. Well, we could, but, they'll go bad in 6 months. What are we going to put it in? Well, we could put in our own money, and then they just laugh at each other and go, you must be kidding me. Like our money is junk too. They say, let's put it in treasuries. No way, that could get stolen. Let's put it in gold. And gold is taking market share as a store of value against treasuries. And treasuries, which are the anchor that determine the value of a currency, the dollar in this case, are how they're de-dollarizing. So they're de-dollarizing, specifically reducing the amount of dollars they hold in their portfolio. Gold has a has two roles here. Gold is really no longer a currency. It's really no longer money in the currency. You're not going to a deli and getting a ham and cheese on rye with a gold coin. Maybe you will, but if you have to, you may as well have a 45 caliber. I mean, it's the same idea, right? But maybe they do that out there. I mean, I don't know. So gold is money though, because gold is a store of value, right? So when the BRICS have devised their method of de-dollarization, I saw the mistakes they made early on, but they got it right now. Whether it's going to work or not, I don't know, but they've got it right. And the plan is this. We're going to put more of our own economic wealth into gold, and we're going to use that gold because they want to start out slow. we're going to use that gold to purchase things from each other that are commodity based. So most of these economies are very commodity based, right? They make their money selling natural resources. And they say, well, I want to be paid in something other than treasuries. Say, well, we'll use gold. I trust gold, but I really am not going to the store and buying a ham and cheese on rye with a gold coin. What am I going to do? Well, now you've got blockchain. You can clap it on. You can facilitate things that they're calling something the unit right now. That's the term for it right now. But what it really is it's a basket of currencies that's 40% gold weighted and then more. And they're saying, I'm going to buy your oil. China says, I'm going to buy Saudi Arabia's oil with 40% my gold and 60% my currency. And so Saudi Arabia says, fine, we'll do that. Now, maybe they won't say fine. So maybe China says, all right, 80% gold, 20% our currency. And so you have these commodity trades being settled with commodities. And that effectively takes the natural resource trade in that part of the world off the dollar. The plan is very good, and I think it's going to work.
So what's the impact of this as this takes hold, as this plan, spreads? I saw that there's something like 159 countries that are going to be coming onto the system here pretty soon. Still may all be on the margins, but as these transactions are taking place, how does this impact the price and the availability of gold?
Well, that's actually the key thing. So now we're talking about price here. All right. It won't all happen tomorrow. It is going to happen. The price of the dollar itself against other fiat currencies will probably rise. What hurts us hurts the euro more. That's that comment. About gold itself, well, we've seen the manifestation of that, and this has been something I've been talking about for a couple of years, and that is as countries, the BRICS countries, decide, and this is the beauty of capitalism in the world. As the BRICS countries say, we want to settle our trades in gold to simplify it. This started during COVID. They start saying to the US, you saw this already, we want our gold back. We want our gold. Say, well, you don't need your gold. We'll just give you a receipt for it. It's like, no. We need the gold. We're doing something with it. Oh, okay. So we give them their gold. We fight about it. So even Germany started 2017, 2016, Germany started repatriating gold. They all, put on the tinfoil hat. They knew this was coming. Okay. And so the gold price goes up because gold is, bear with me, useless. It's a pet rock. And because it's a pet rock, it can sit in your vault. It can sit in my vault, and we can exchange pieces of paper about it. But when you find a use for it, wait a minute, we can use these instead of treasuries. Well, I need to have my gold I need to say, here's my gold. I have it, right? Well, it becomes, paraphrasing Pozar, it becomes a crisis of collateral. So if every country in the world that doesn't like the U.S. says we want our gold back, that means the U.S. financial institutions that are using gold to leverage it for more deals, $1 trillion worth of commodities, create $20 trillion in economic value in the West, right? So they take their gold bar back, their one gold bar, boom, right? That means all the futures trades that are based on that, all of the business models that are betting on the future of that delivery of gold, they're gone. They can't count on it. So the shortage of, it's a collateral issue. The shortage of good collateral with which you can do good faith trades in the West and leverage deleverages us. Gold, it goes up in price, not only because they're taking it back, but because to the extent that you're a Western country and you need to keep that financial leverage, you have to start finding more gold. You have to replace it, right? So the price of gold is being bought by three entities right now, three macro entities. One is the BRICS. They're buying, they're repatriating their gold, and they're buying more because of this MBridge platform. MBridge means monetary bridge, right? It's a monetary bridge off the dollar. The second entity that's buying it are the Western entities that we've lost 50% of our gold to do business with. We need to find other sources of it. So now they're paying higher prices for it. They're raising the floor on the price. And the third entity is an extension of the second entity, and that would be bullion banks that are short too many futures against physical metal. So the price of gold is going up because they found a reason to use it. And so Saudi Arabia, China, Russia say, you know what? That doorstop you have over there in the West, we need it back.
Well,
And
what a
so,
great what a great lead in for this question. Well, I think you kind of answered it. Actually, I was going to ask you, as gold, we saw gold reach all-time highs yesterday. It's busted through. It finally broke out of this consolidation it's been in for several months. I was going to ask you, what is that saying to you? But I think you just answered the question. So let me move on to this next question, and that is, Vince, historically, gold's been negatively correlated with real interest rates. When real interest rates rise, gold prices tend to fall and vice versa. This occurs because high real interest rates can make treasuries more attractive to some investors than gold.
Right.
However, despite a substantial increase in real interest rates since 21, gold prices have reached new all-time highs. What is your analysis point to what's going on there? Is it tied in with what's happening with the BRICS?
Absolutely, absolutely. It's directly tied in, and I mean, again, this is something near and dear to my heart. The media, the legacy media, the mainstream media, even the banks, when gold started rallying, started saying this, as we probably all said it, myself included. Well, gold's going to sell off. Real rates are going up. Gold's going to sell off. The dollar's stronger, and it kept not selling off, or it kept selling off and getting scooped up. And then I identified who the buyers were, at least broadly who the buyers were. And I started asking myself, well, the correlations, and this is kind of philosophical, but I think people need to understand this. The people that preach correlations to us, and I'm not saying they're not valid, the people that preach correlations to us lack imagination. They think the correlation determines the market. The market demand determines the correlation. Why did gold drop when real rates went up? Well, the answer is because opportunity cost is big, and I'd rather own something that makes me money than just sits there being useless. Fine, let's work with that. Why did you do that? Well, because I trusted treasuries. Because I trusted America. Well, what if you don't trust America anymore? What if you're a BRICS country and you say, you know what? I don't give a damn about your interest rates because I'm in China now. I don't let my people buy American goods. I'm not buying dollars anymore. And so I said the correlations aren't broken. And I say this mathematically and from a macro analytical perspective. The correlations are not broken. If it's denominated in dollars, and the stronger the dollar gets, the lower gold gets in relative price. But the correlation has been usurped by these bigger picture issues. The correlation is there to your macro people. The correlation is there. The beta has changed, right? So the beta it's kind of like when the dollar weakens, gold goes up $20. When the dollar rallies, gold goes down $2. So it used to be when the dollar weakens, gold goes up $2. And when the dollar strengthens, gold goes down $500, to simplify it. The correlation is still there. The beta has changed. And why has the beta changed? The chart you want to look at now, it's really eye-opening, is gold. The chart that people look at traditionally, and I'll give you a copy of this chart. The chart that people look at traditionally with the yields thing is the gold price versus yields inverted, right? The gold price yields inverted, and they move the same. As the yields go up, gold goes up. As the yields, the inverted go down, right? And now we have this big alligator jaw on the chart. Well, if you take that gold price and you correlate and you overlay it with Chinese bond yields, you get almost a perfect correlation. So as interest rates in China have decreased, here's the key, as the opportunity cost of interest rates of owning gold have dropped in China because bond yields are so low, they're buying gold. They're not buying treasuries. They're not closing the gap on China versus the U.S. U.S. has become the pariah in the East. And so the correlation doesn't matter right now. That's why the dollar is strong and gold strong. That's why bonds are strong and gold strong.
So it's interesting. You were making me think this, and I don't know if there's a correlation here, but I was going to ask you, in your analysis, how does the environment for gold today compare to previous bull periods of like the 70s and early 2000s? And you were making me think that the correlation is between present day China and the 1970s. I don't know, but do you see any correlation in the environment for gold today and previous bull runs?
I do, and that's actually an interesting new concept. How much, whereas as China's economy goes, so goes gold. Will that be more of a driver of the price of gold going forward? Other than that's a really good point. That's an interesting point you brought up. Uh, I have an opinion on that, but I'm still developing it. Let me just put it this way: China will continue buying gold until they need their own people to buy stocks, and then they'll tell people to sell gold and buy stocks, and then gold will go down. You follow?
Okay. Yeah, yeah,
Right.
yeah.
So I'll just summarize that. China's like, we need you to buy gold because we hate dollars, and that's like, shit. We need you to buy our stocks because our economy is going to zero.
Right.
Like that's the risk. That's where you sell gold and buy gold miners in China, even though they're up. But to answer your question about kind of the economic analog. Oh, I think I'm not really sure how. Would you mind restating that part of the question because it was a double part.
Yeah, yeah, yeah. I'm just curious if the environment for gold today compares with previous bull periods of the 70s and early 2000s in any way.
Oh, um, uh, it doesn't because we're remonetizing gold, right? Asia and the BRICS are using gold, yada yada yada. We all know that story. But here's the trick. Here's the trigger. We're going to heal relationships with them. We're going to need what they have, whether it be lithium or copper. And so the negotiation is going to be like this. The BRICS are like, we have our SWIFT system, you have your SWIFT system, never the two shall meet. And then the West is going to say, well, we want to do business with you. And the BRICS are going to say, well, you want a lithium? Pay in gold. And so the West will come to the table, and so will the BRICS. Let's be clear, they're not in control here, but there will be a compromise. And so the remonetization of gold will keep a bottom under gold going forward. Gone are the days of the IMF confiscating a third world country's gold and then hitting the bid to repay dollars. That mechanism is being unwound. So that's where it's very different. Gold is being remonetized, not being demonetized, right? Where it's very much the same goes with the inflationary thing, and it's very domestic. Look, we're going to keep spending money because we need to change our economy. It's a mercantilist environment now. We need to make more goods than we buy. We need to export. Everyone is trying to export to help their economies. And that means everyone's buying raw materials. And that means the price of gold goes up. And that means eventually inflation gets killed, but it won't be for a long time. And it might not happen until an economy like China craters. So the parallel is the similarity is in the US, there's an absolute strong similarity in the fact that government spending is going to keep a floor under gold, period. Whether we're spending it for the right or wrong reasons, yes. The other similarity is China is using gold as a safe haven out of treasuries, kind of the same way we used gold as a safe haven getting out of everyone else's currency back in the day. So there's a lot of similarity to it. I think if we do it right, gold goes a lot lower. And gold goes a lot lower because there's only one thing that makes me think gold goes a lot lower, okay? There's only one thing that really cures inflation, one thing, and that is we find a substitute for oil that's more energy efficient and cheaper to make. So your hedge for being long gold should be being long thorium reactors. If thorium reactors become scalable, I'm making thorium, it could be nuclear energy, it could be whatever, but if we can replace oil and become a low-cost energy producer, then I'm going to be able to make my finished product which is this microphone, let's say, and go and sell it to Kazakhstan for $5 with a cost of production of 50 cents, right?
Yeah.
Meanwhile, you're in China making your microphone using old-fashioned oil. And
I think they've thrown, what, $5 trillion at this concept over the last 15 years, and they've moved the needle by 1%, maybe.
I know.
Yeah. Hey,
So
all right.
that's why I'm not bearish gold.
Yeah, perfect. All right. So, Vince, what are some trends that you're watching for in the commodity space, and what's your analysis pointing to for the sector over the next 6 to 12 months?
Oh, okay. I had a very strong feel for this for the last 2 years. Right now, it's a little bit muddy. It's muddy because I think if you're focused on oil for a second here, right? The oil market this is a little bit more tactical. The behaviors that I'm seeing manifest in oil are getting very unnerving. Here's what I mean. When you look at I've been trading oil forever. In fact, I made more money in oil than I did in gold as an options trader. The behavior in oil has changed significantly. The fundamentals are mattering less sometimes. The big funds that genetically play from the long side, they're gone. They're not playing anymore. They always hold some longs as inflation. Maybe they're in gold now. I don't know, but they're not in oil anymore. The CTAs, which are the smaller retail aggregated funds, commodity trading advisors, when they play, they're moving the market way more. And as the demand for oil goes eastward, it goes WTI, Brent, African sweet. So maybe it's Nigerian. So the WTI market itself as a commodity is becoming less important. And the futures are breaking. And as a market, the oil market is becoming smaller for significant well-heeled players and larger still because the government, I think, is trading a lot more. So I believe commodity prices will start to bifurcate even more. And so what I mean by that is you may see oil stay in a range for 3 years, although I believe it will work its way higher for serious reasons. But you may see the breakfast foods go to infinity, like we had a couple of years ago. You may see lumber spike, like they don't care as long as they keep energy out of the news. So we are feverishly, we're at a crossroads now. Commodity prices are now at a point where you're encouraged to start looking for more, but the flow of global commodities is broken, and so I think prices stay high as a result of that. So
This has been an incredible conversation. Before we wrap up here, and I ask Vince our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. They're all up there, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Vince as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. It's now time for our Golden Nugget segment. Vince, let's discuss portfolio positioning. Based on all we've discussed today and with your experience and your worldview as a backdrop, how are you positioning for the next 12 months? What assets do you like, and what assets do you absolutely want to stay away from?
Well, as a trader, I've been playing the long gold short bonds trading. Okay, and by the way, to simplify, that's an extremely inflationary trade. So it's kind of like this. If there's inflation, either gold goes up or bonds go down. And if they both happen, which have happened for an extended period of time, you're great. So at the retail side, it's long GLD, short TLT. It's a disaster in a deflationary environment. So strengthening yen supposed to kill gold and make bonds rise. Not necessarily, but you're betting on inflation. That's a trade that I've had on, and I'm thinking about putting on again, but I think it's too risky. But to answer your question more quantitatively, from the 60-40 portfolio perspective, I'm 60, 20, 20, 20. Well, that's 120, right? Yeah, that's left.
Very much Zoltan Pozar. 40,
Right.
20, 20, 20.
Yeah, exactly. I'm 60, 20, right? Exactly.
Yeah.
But I'm 120, so that means I'm leveraged. No, but seriously, it's 60, 20, 20. It's 60 percent, but it's not stocks and bonds. It's 60%. Okay, here we go. I'm heavily weighted this way, okay? I'm 60% precious metals right now. That's me. It's going to change. That's for the next 12 months. And I can give, that's not for the next 5 years. I can tell you why I feel that way. And maybe you're slated to ask me that. 20 is stocks, and then 20 is aggressive stocks. So that's where I am. So the other 20% is me speculating on whatever's going on tomorrow.
And so the asset class that you're staying away from, though, is long-term bonds?
Yeah, I made money shorting them. I really did. And but now we're at a point for the next 12 months where the Fed eases. Look, I firmly believe, this is what I believe, and it's worked, but now I'm not sure. I firmly believe that long-term yields must go up. This is an economic comment. If long-term yields do not go up, 10, 20-year yields, if they don't go up to a higher level and stabilize 5%, then inflation will come back 2 years from now in a way that you will not be able to control. Higher long-term yields, and this is the key to this, higher long-term yields kill the inflation that we've cooled off. If we don't have higher long-term yields, when Powell eases, you're just going to reignite inflation. And paraphrasing Pozar, as recently as May, he made the comment, and I had a sidebar communication with him. We're not friends by any means. I'm just happy that he answered me. I said, the yield curve needs to steepen, right? And I long email about this, that, and the other thing, and his response was, yep, yield curve needs to steepen. And so in that write-up he did in May of this year, his comment was, there is no term premia in the bond market. And until you have term premia or a higher long-term yield, until you have that, the economy is not fixed. So, and coming back to your answer, I believe that, and that's why I was short bonds. But now the Fed's going to ease. Yellen's having her way. Maybe I shouldn't be short bonds anymore. I don't know.
Well, I appreciate your wisdom. Thank you for coming on to Metals and Miners and for being so generous with your time, analysis, and ideas. It's been incredible to spend this time with you. Would you please share with the viewers, what's the overall theme you want to leave with those tuning in? Where can they learn more about your work, and how can they connect with you?
Well, the theme, well, that's a mean question. I don't know what my theme is.
That's fine.
But maybe I'll think of one later. But I have a Substack letter, right? And it's, as you mentioned, vblgoldfix.substack.com. You can just look up Goldfix. And I've been writing it for almost 3 years. It started as a hobby during COVID, and it's become something quite legitimate. We share, it's a big umbrella. So we'll touch on the topics that you cover in depth. We'll do macroeconomics, we'll do secular change, and we'll do tactical stuff on what you would do tomorrow. And so that's all tapping into the same knowledge base that we have. But we also have in the premium section, we have access to through a mutual colleague, we have access to bank reports, and those bank reports are very insightful, and they are the jumping off point for our own analysis, and that's the premium stuff. So you can get a lot there. We send a couple emails a day, so in that sense, it's very busy. But we don't send any junk out. If you sign up for free, you're going to see some good things. If you sign up for premium, if you're inclined to do that, you're probably going to get a fire hose of content that you may say, I don't know what to do with all this. But anyway, it's all good content. That's it.
On X?
Yeah, I am. X, exactly. X, formerly known as. Yes. My first account got banned under the old Twitter regime. My new account is Soren the K, SORENTHEK, where I will make comments like this that we've been talking about. I will also heavily couch them in sarcastic or off-color humor. So if you're going there for, if you're going to X for information, just be prepared. You're going to be peppered with some other things as well. Stick with Substack if you want pure data.
Everybody, I'm on his Substack, and I've been following him on Twitter. He's got a great personality. He's funny. He does add a lot of color and humor. You will enjoy it. But more importantly than enjoying his content, getting in and getting educated. Get educated under Vince. You need to learn what's going on. You need to hear. He's got his finger on the pulse, and he is sharing with his community. So everybody, go get connected with Vince. I look forward to having you back on. Thank you for being here with us, and everybody else, thank you for watching.
Wait, don't say goodbye yet. I know what my theme is. You're going to like this. This is good. Because you just said my theme. The media has dropped the ball. The educational media in the form of the mainstream or legacy media has dropped the ball for the last 20 years on helping investors make better decisions. Absolutely. I'm talking about the CNBCs, even the Bloombergs, okay? What's happened over the last 3 years? The gap has been filled by ad clicks, salesmen, and sensationalists. It's still hard to find good content so that you can make clear decisions. So my point is, my theme is your theme, and that is it's harder to find, but there's still good stuff out there. To the older people, guys like Gary and I would include myself in that group, are trying to give you real information to make your own decisions. And to the younger people, I'd say the stuff you're watching, most of the stuff on YouTube you're watching, it's trolling for farming. It's farming engagement. So there you go. Yeah, that's my theme. Okay. Stick with us.
Yeah. Well, I appreciate that. Thanks for halting me. All right, I'll go back. I look forward to having you back on, Vince. Thank you for being here with me. I really appreciate it. And everybody else, thank you for watching.
Thank you, Gary.
I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. They're all up there, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us.